What if we retired at 65 instead
What
of
if one of us
67?
needs long-term care in our 60s?
What if we downsize our home now instead of waiting?
Welcome to another episode of the What If Show, brought to you by Thomas Gold Solutions, the team behind Retirement Analyzer, the refreshingly simple software for financial advisors to use when developing and managing retirement plans for your clients. Last episode, we walked through how new users can get started with Retirement Analyzer. On this episode, Brooke Thomas and Steve Goldstein are going to walk you through how to show your prospects and existing clients value quickly with Retirement Analyzer. Well, Brooke and Steve, it's wonderful to see you both again. I'm super excited for this episode. This is one of my absolute favorite topics. So who's ready? Excited?
Great to be back. Let's do this. Yep.
Thanks, Mike.
It's good stuff. Good stuff. Okay. So, in the previous episode of the Getting Started episode, we talked about how everybody has that moment where they, click the piece of software and, I don't know what to do next. Well, everybody has also experienced this moment. Okay, I've got a prospect. I've got an existing client. I want to show them something powerful. So let's talk about getting to the aha moment quickly. How quickly can a financial advisor create that aha moment, that feeling of value with Retirement Analyzer with a prospect or a client?
Showing them all their numbers in one place, probably for the first time ever, is a kind of a wow moment. Like when you kind of bring it all together with Social Security and pension and rate of return on your investments and your monthly expense plan. The first time they see that, I mean, they're impressed. And I don't think there's a lot of people out there. There's still many, many advisors that don't go through this kind of deal where the holistic plan, where you bring it all together. And once they see that, I mean, that's enough to start them to feel that you mean business as their advisor, I think. And then you can get into alleviating the red line or, hey, what does it look like to work longer? Or what if we do this? Or what if we do that? And the effect it'll have on your plan. But I think just the one thing, and maybe I'm, I don't know, Brooke, I think this is right. The first time they see it all brought together in one spot is a wow moment, in my opinion.
Yeah. And I think for clients, a lot of them just asking to put their monthly expense plan together is a wow moment in itself. I mean, it'll take some of these clients an entire month to walk through and actually look at what they're truly spending, bring it into one consolidated plan. And I think that is a big wow for the client, but a big win for the advisor.
It's really this, though. We still have these advisors they're out there. They want to cut corners, and they're worried about requiring a monthly expense plan so we can get the analysis looking correct. You have to do that, and so I think that showing a client their plan, like we were saying, plus requiring them, hey, look, this is what we will do if we work together. I need this, and this to make sure we make your plan as accurate as possible. So, but just that whole plan together as one. That's a big deal for them. Probably the first time for most.
It's really interesting. You just teed up something that I think is worth noting here. Like some of the value you're going to show is the conversation. It's even before you actually start using the software, it's having that conversation. As you said, Steve, telling the client like, hey, we're going to dig into some stuff here, right? This is especially if it's their first time ever working with an advisor, they don't know what to expect, right? As a client, you're the leader. So asking for, let's go through all of your expenses. Let's go through all of your income. Let's look at all of your assets and liabilities. So we have a full, rich picture of what's going on in your financial life. That's powerful stuff. That could be an aha moment in itself.
I think the requirements that you have could be an aha moment, if that makes any sense, right? Yeah. Just like you said, if they mean business, or that shows that you mean business by requiring certain things, I think.
Let's talk about that too, though, because when you roll into an appointment and you're asking for all of this information, especially with a new client, I mean, it is a lot. You're asking for retirement account information, Social Security. I mean, across the board, you're asking for everything. So Steve and I have a lot of luck actually showing a client a sample plan and the why, as far as, look, this is what we're going to be able to provide. And this is why we're asking for all of this detailed information, because it is a lot. I feel like, Steve, they get a little reluctant sometimes. It's like the hair on the back of their neck stands up because it's just a lot. So I would encourage advisors, right in the Retirement Analyzer locker, there's a sample report printout. I used to print it out and actually keep it, in a nice bound booklet that was look like what we provide the client when we're done with the analysis. But show that to them before you dive into all of the fact finding.
Let me add on to that just a little bit too, though. So I think really what it comes down to is helping them understand how important the plan is. Okay, you want to spend money. Hey, listen, everybody wants to spend money. Let's look at how you spend money. This is the way it's going to look unless we do this, this, and this. When they start to understand that hey, look, every month, the rest of your life, you're going to you're going to want to spend money. We have to make sure you can. And when they start to feel like, wow, I need this plan, that makes it a heck of a lot easier to deal with the clients because they'll provide what Brooke's talking about. You have these requirements. That's what we need. And they come through and they actually do the work gathering. So it's just important.
I love it. I love it. And I love the concept of showing them a sample plan, of taking it and making it just a little bit abstract, right? This isn't your numbers yet. I can walk you through something and show you what does the plan look like. I could also probably point out some areas that have potential discomfort and like lower that discomfort level. Because, in most cases, when a client is talking to a financial advisor for the first time, this might be the first time they're ever talking about their finances with another human being. Because in our society, it's an uncomfortable topic. We're talk, to never talk about politics, religion, or money with people, right? And suddenly here they are talking about money with somebody that is kind of new to their life.
Right. It really is that way. I mean, they're nervous. I think the people who drop the ball as a financial advisor kind of use the industry jargon with them, expecting the client to understand it, which they don't, and you'll just lose them there. So it is a delicate process. It is. But, you have to respect, just like you said, Mike, it could be the first time. So keep it simple, show what you do. Walk them through whatever, right? You can show them a sample report if you want. And I always use this. These are the kinds of the sample. Show them maybe somebody had a red line or they were running out of money, and this is what we did in the sample. These are the kinds of things we can do if we decide to work together. That's what I would, and that kind of helps them understand that, hey, you could be like this sample client. Hopefully, let's make some changes and we can talk about it. But that's where I think the lifelong client relationship is established right there.
So, Steve, I don't know about you, but I feel like the budget and the expenses are typically one thing that a client tends to resist if they've never been through this exercise. As I said, it can take them a month long to kind of gather all of that information. But for the advisor, if you have somebody that's really reluctant to do the expense plan exercise, we do have a sample file. And it's really interesting. In the sample file, you have a client spending $10,000 a month. It's a clumped number. And then you go to tab 7, which is our summary tab, and it shows them tanking and running out of money. Okay. We take that same exact client. We take the same exact $10,000, but we ask them to itemize, what makes up that $10,000. In this case, it was a mortgage with principal and interest, et cetera. And we can show that mortgage P&I ending when the mortgage is paid off. So we can put that end date on it. We can put a 0% inflation rate on that chunk of money, which in itself is huge because that's typically, the biggest chunk of somebody's monthly expenses. And so it's the same 10 grand. So they go from tanking at a clumped number. Now we itemize the same 10 grand and now they're fine. They can pay their bills. They can live for the rest of their lives. So that's a really good sample file that will kind of open a client's eyes to, the why. This is why this is so important.
A news flash. Can I pop a news flash in here for advisors and clients? In the case where Brooke's talking about itemizing, and it's so much of a better outcome, mathematically, a lot of times, let's say they're spending $10,000 and you don't even do anything but put a 3% inflation rate in, like Brooke's talking about. It gives you an outcome. Doesn't look very good. Yeah. And then you take the same $10,000 and you itemize, and it looks a lot better. I'd be willing to say here, okay, mathematically, you could spend more. So you could spend 11 or 12,000 and itemize and still be in front of the one that wasn't itemized. That's how it works. So clients would love to know that. They could spend more and still be okay, actually better than if they didn't put any of the work in creating their monthly expense plan. Yep.
Well, it's so important to dive into why that is actually true. And I know you do, but for the new advisor who's here hearing this and going, what are you talking about? How is that even possible? The fact, Brooke, you mentioned it, so I just want to be a little more clear on it. Your mortgage and the principal and interest is a fixed expense that is not going to be subject to that inflation rate. So if you just say I spend $10,000 a month and I want to maintain my spending power, my buying power, if you will, consumption power over the course of the next 30, 40 years of my life, well, we're going to adjust that with inflation because $10,000 today, 7 years from now, 20 years from now, might be twice that in actual dollars, might be $20,000. We have to adjust it. But if your mortgage is staying the same every month, guess what? That $2,000 mortgage will be the equivalent of like $1,000 out of your pocket 20 years from now, right? So it'll be a much smaller number. So inflation doesn't affect everything the same, and some things will be non-inflation adjusted.
It's huge. And what's interesting too, if you've got a client that just won't do the work, even if let's go back to our $10,000 example. Say they had $10,000 a month expenses and $2,000 of that was the mortgage. Even if an advisor can just show the $8,000 with the normal inflation rate and separate out that $2,000 that's attached to the mortgage and put that portion at zero, even that can make a huge effect on the overall outcome. So there's lots of ways to do it. Ideally, a client, they're going to go in and they're going to break it apart and actually give us the numbers. That's in a perfect world. Now, Retirement Analyzer has a lot of cool little things to help from a budgeting standpoint. You can actually email out expense plans where a client can fill it out electronically. Then you just import it right back into RA. So we've tried to take some of the legwork out of it for you guys too.
I love it.
You really can take expenses to the next level. If you become a guru in expenses, okay, the expense plan, you could actually, if somebody were to pay you a charge just to help them understand their expenses, I think it's worth something for clients to do that. If you get them to that point, though, then you run into this, the go, slow go, and no go kind of stuff. So you're not going to have a car payment probably after age 90. There's certain things that are going to stop. So in your initial example, when you use 10,000 and you just, basically let it increase by inflation, what about the costs that stop? Okay. How many vacations are you going to take after 90 at $15,000 a year today? See, right. So you have the ability to really get into it. And I think Brooke and I both think that this is the monthly expense plan is the cornerstone of the whole plan. It controls everything. And so if we can get as accurate as possible there, it's very helpful.
Yeah. I got to tell you what, the example of breaking out and itemizing things, especially when it comes to a mortgage rate or any other type of fixed payment, that alone is an aha moment that will get you like, oh, okay, I really get the value of this here. Like, oh, we're doing this professionally now.
Yeah.
It's great. I love it. All right, let's switch gears to like another topic that I'm hearing a lot about in the industry, and I'm sure the advisors who are watching or listening may have as well, right? That advisors today should offer some level of tax planning and tax guidance for their clients. Now, I hear that, and then I also am aware of the fear that a lot of advisors have, especially the newer ones. They say, hey, listen, I'm not a CPA. I don't want to step out of my lane when it comes to taxes. I just want to, do the financial advisor, the investing type of thing, or maybe do some high level financial planning. But, the reality is like clients don't care about your lane, right? They care about their financial lives. And taxes is an area where you can show almost immediate benefit, right? I could show you value like day one, like how you can radically change your financial life.
Yep, you can. And I got to tell you, 15 years ago, nobody wanted to talk tax. Okay. See your CPA for that one, whatever, yeah. Right? We can't talk tax. Well, we've made tax so simple and it's in our software now. There's certain modules. Taxes aren't really hard.
Yeah.
All right. You know why it's an opportunity? Nobody wants to go there, but all you have to do is understand the rules. The math is simple, right? The math is simple. So basically what we've done is we've actually taken it. And you want to talk about the difference between a tax rate and a tax bracket. You want to talk about a tax credit or a deduction. You can talk, general taxation using Retirement Analyzer. You can. And so what we've seen over the last, I don't know, Brooke, 5 years or so, people start to feel comfortable in the tax conversation. It really isn't that hard, but people are half asleep when you start talking about it most of the time. But that's an opportunity. So to me, we do the tax, for all of these analyses in RA, and we keep it updated every year because things do change. Sometimes mid-year, when the big beautiful bill came out July 4th last year, we had all the updates by July 5th, and it was ready to go. So, but all you have to do is understand the rules, and it's not hard to explain, but nobody wants to do it.
Well, and I know that that might be a new conversation for a lot of you advisors. You've not really, gone there before. In RA, Steve mentioned earlier in podcast too that we have quick clips. And so we literally, on all of those tax pieces in the platform, have a little explanation of, look, here's how you explain this to a client. So, for example, a lot of clients don't understand that taxes are progressive. They think, oh, if I'm in the 22%, I pay 22% on every dollar, for example. So being able to explain that to them and show them that it's a progressive tax and how that works is a big deal. So the quick clips walk you through all of that so that you can get comfortable having those conversations.
What are some of the biggest high impact, high value tax conversations that you see popping up to the surface quickly when an advisor is using Retirement Analyzer with their clients?
Doing Roth conversions probably save a lot of tax, right? You got to watch though what age you do them. But yeah, there's a sweet spot there where you can actually have your clients, at least they don't have to convert everything, but when they start to convert, I mean, the tax savings could be substantial, And then we also have the, a lot of times when people say, well, Roths aren't worth it, okay, because the client's too old or they should keep their IRA or whatever, you can jack the taxes up at some point in the analysis to show what if taxes go up 20 years from now and you haven't converted. But I tell you, I think the biggest tax savings we've seen is to either convert or spend the qualified accounts, which are IRAs and 401ks, first, because we're in such a low tax environment now. So what I'm trying to say is if you have negative cash flow, and let's say you have 10 assets, what we find people doing is pushing the qualified accounts up into position number 1 or number 2 so they can spend them now in this lower tax environment. Okay. And we're talking about people who are retired now.
Why does this tax conversation create so much engagement with advisors and their clients? It's really interesting to think about, like, nobody likes tax. I mean, everybody hates taxes. If we all pay no taxes, none of us would want to, but we get stuff, obviously. People understand that, it's a requirement for living life is to pay taxes. Why do you see that this is such a area that creates vibrant conversation with clients?
My opinion, people hate taxes. I'm talking about clients. They can't stand paying taxes. The worst week of my year is April 15th week. Okay. I can't stand it. Writing out that check drives me crazy. So if you can show me some way to avoid that, I love you,
Well, and I just think it's something that a lot of these people, like Steve said, they all hate it, but they don't know how to get rid of it, right? They don't know how to fix the problem. And so Retirement Analyzer, in my opinion, it shows, first of all, the pain points, how much tax they're paying. We've got a cumulative tax chart. It pains me to look at it. It literally shows the taxes you pay over your lifetime. Awful. And so if we can go in and we can pull some strings and watch that chart go down, and then we can crank up taxes and watch that chart not move because we've eliminated the tax risk. It's really awesome to be able to show that to a client.
I just want to echo what Brooke just said, though. Okay, so and we have sample files that are like that. I just want to make sure we got what she just said. She said that we can do nothing and raise the taxes and watch how bad it is, or convert or do something and then raise the taxes and have no change because we actually put the strategy into play and now we're not affected by what could happen if you didn't do it. So make sure we got that. That's important.
What's interesting to me, and love to hear your thoughts on this. Like, when it comes to tax planning, right? It's less variable, if you will, than investment planning, right? So when I'm thinking about investment planning, I'm thinking, okay, well, if I get an average rate of return of 7% on my portfolio over the life, there's a lot of variability in there, right? But with proper tax planning, you can have the same impact as if instead of getting 7%, I got 8%, much more predictably, right?
What, tax planning versus
Yeah,
investment
tax
planning?
planning versus investment planning, right? So you get where I'm saying here. Like, this is an area where some serious high impact stuff that is really easy to understand. Like, I could save a bunch of money, or I could pay less taxes. I could have a much higher impact than on just investments.
I guess we can have a conversation on what's more risky,
Yeah.
having to pay tax or the market crashing. Okay, so I think that, just picture this though. If there's somebody in the administration and they actually vote to raise taxes, let's say you have $2 million in qualified accounts, and the tax rates go from 20% to 30%. You just lost a lot of money. Okay, now you could buy portfolios obviously in the market and hedge yourself. That's great. So I would be more worried about change in tax policy because I could just lose it overnight versus the market cracking or whatever and being in safe stocks. So yeah, it's important. It is. And so the people and Ed Slott's a great guy. I mean, he does a great job at what he does. I mean, we're talking about, IRAs that if you don't spend them down, grow into this big problem. It's like a retirement time bomb, I think he calls that. You could have $2 million in your account, in a qualified account at age 70, 73, 75. That's not, I can't say great work. It scares me, because you're going to have to pay tax and we don't even know how much it could be. And that's the problem though. Okay. So people have to be schooled on that. The 401k, if you don't have a match, might not be the place to put the money. Right, Brooke?
Well, and I would encourage an advisor to ask a client, you see people just dumping all of their money into 401ks, not even necessarily getting a match. I would encourage an advisor, ask the client, how much of that 401k is really yours? They every time will give you the exact dollar in the account balance. When in reality, it's really not. They're going to give a large chunk of that to the government for taxes, right? And they don't think about that. Now, Steve and I are believers, if they're getting an employer match, it's hard to beat that.
Yeah.
But if they're not, you might want to look at alternatives that really could help improve their tax situation.
So tax planning is incredibly important. It's a great area where we can show value quickly for an advisor using Retirement Analyzer. Let's switch gears a little bit to something that's near and dear to Steve's heart. And I think we're going to be talking about this on every episode to some degree. Steve, you notoriously say you hate sales. You prefer to be an educator because you just feel like it's a much better way for you as the advisor, but also for the advisor client experience to have a better dynamic. So how does that work? How does this kind of, maybe using the Socratic method, if you will, right? With a client? What do you look at as like the best process to use Retirement Analyzer and help it position you as an educator and have that kind of dynamic with a client?
Well, I mean, you can answer when you get going with this thing, you can answer any what if question that they have. They can fire anything in from right field, and you're ready for it though within a couple of keystrokes. We could do everything. We could do, just like we were saying, Roth conversions. We could do charitable giving. We could do donor advised funds. There's all kinds of stuff that you can do here, and an RA handles all of that. So it kind of helps you come across, and you really are the expert once you know how all the moving parts are affecting. Okay, and no, I think that you use the software, you become the expert. And to me, the expert is having answers to all client questions when they ask them. Okay, and being able to guide them if they want the guidance.
Well, and don't be surprised if the client starts calling saying, look, I want to do a vacation to Italy and I want to pull 20 grand out. I mean, they become dependent on all of those answers because you just plug it in and you can spit out the answer. And the clients love that.
Yeah. One of the things I love, and we teed this up in our previous conversation or an earlier conversation about inflation affecting certain things and not affecting certain things, right? About getting into the details and how important that is. That is an educational approach to this conversation, right? Like, oh, let me tell you why we want to do it this way, or let me walk through the benefits, this or this. Brooke, you were recently just talking about should you max out your 401k or should there be a different alternative investment? Let's talk about the benefits of each. That's an educational approach, right? Versus just like, hey, here's what we're saying you should do.
Yeah. And I think, again, you're going to lead the conversation with the what ifs. Okay. So we're looking at the pain points, and then we're purely putting in product kind of on the tail end to solve some of the pain points. So I said this, time and time again, but it just changes the conversation. It really makes it about the education rather than just cramming a product down the client's throat.
Yeah.
Mike, if I can add this too, though, I mean, when you're going through the program with a client, I mean, how can you not teach them anything? I could just imagine, Brooke, going through tabs 1 through 3 and not saying one thing to the client. They give you the account balance, you put it in. I mean, aren't you saying like, well, this is how this works and this is why I'm putting it in there? I mean, you have to have that kind of educational relationship going there. And I think that's why they buy you. Why? Because you're the true advisor. You're helping them. So explain it as they give it to you, and there's your education, right?
A little fun thing. I'm sure this is in some advisors' minds, but it's worth noting here, right? When you're working with Retirement Analyzer, it's helping you adhere to a more compliant way of offering financial advice as well. Walk us through the kind of how this approach works and why an advisor can feel confident in the advice they're giving and know that they're operating in a compliant way.
Well, our RA is really just it's a track to run on. Okay, the tabs aren't changing. Okay, you go through 1 through 3, you collect the data, and you look at 7 to see if they're going to be okay. There are some safeguards in there. Okay, you can't put more than a 10% rate of return in there. You have some limits on certain things, and also here's the best thing I think though. When you actually create a scenario with a client in it, let's say we're in March of 2026 right now, and you create the scenario. Okay, next year in March, you copy what you have in 2026 and you move it to 2027 and you basically update everything. But what do we do with the 26? The 26 goes into an archive and it stays there, okay, in case you ever have to answer questions on it. So there's a lot here, okay? We compose the software to keep you on track. There's certain things that you can't do in the software, okay, because it could look too great. And I don't want to come across wrong with that though. If you're going to put a 10% rate of return in every year, I think you're going to have problems there. Okay. Because they will have $43 million, but we're not doing that. We're looking at conservative estimates and providing something that the client can be happy with. And if we beat them on the upside on projections or whatever, then that's surprising them on the upside. Okay. That's what it is. But you keep the files. If you have files from 2017 Retirement Analyzer, which you should if you've been using it for long enough, the 2017 taxes are in that file. Okay, so all the tax structure stays in the year that you save. Okay, so remember the 10, 15, and 25 tax brackets or whatever? They're in on the 2017 analyses. So there's a lot in place here. You save everything. You show the path and you show why you make recommendations and you keep the client's best interest right here at heart. I think that's all you need really. And that's what we have in place. So it's a track to run on to keep everybody safe.
It's really interesting is that concept of like, hey, listen, we're going to have every year's updated plan as an archive. Not only is that great for compliance, right? But it's also great for the client and advisor relationship. I can show you, hey, we're having our annual meeting, Brooke. I will also let you know we have a previous year's plan here if you ever want to reference it. Oh, by the way, remember like 2 years ago, we talked about this, and this, whatever, and this is what the plan looked like. Through the work we've done, here's how we've improved. That's a dramatic show of value, right?
Oh, it's a wonderful exercise to do for people. Just, here's what we projected. Here's where we actually landed. Another thing to think about too is when you go back for that annual review, what bits of information do you ask the client for again? A lot of advisors, oh, I don't need to do the budget again. I tell you what, yes, you do. You really do, because people's budget in a year time frame, it can really change. And we've said it time and time again, $100, $200 a month can really make a big swing when you project it out over long periods of time. So Steve and I are believers, always review the budget, every annual review, then grab those updated Social Security values, retirement account values, et cetera. But year 2 in those annual reviews, just updating that bit of information, it should be rather quick to do. And then you're just talking about how you can tweak the plan further to better your outcomes.
You mentioned that like the $100, $200 a month can make a huge difference. And I love that. And as you were saying it again, it really hit me that how important it is to have that conversation because, back in the old days when I was in school and taking economics and so forth, we talked about inflation. My professor talked about inflation, and he's like, there's two types of inflation. There's actual the inflation rate of, the CPI rate, the 3%, whatever you see. But then there's personal inflation, right? There's your consumption inflation. Like 10 years ago, relatively few people had multiple streaming subscriptions to Hulu and Netflix and HBO and Spotify and on down the list. And now almost everyone has at least one of those streaming subscriptions, right? And they're changing over time. So that the basket of goods and services that you're spending money on are going to change. So you're so right. And this is a huge area that the advisor could have a big time impact on is let's understand your spending today because you might be surprised at how it's changed.
Healthcare tends to be another area where clients are concerned, and when you look statistically, that's one that's growing much more rapidly than your average inflation rate. And so in RA too, you can write in that expense plan. If you itemize it out, you can show the healthcare piece of it. Maybe you want 6 or 7% inflation tacked onto that. And then you can just keep revamping every year. So yeah, the $100, $200 a month. I mean, I think we all feel you go to the grocery store and the $100 that you spent 10 years ago, now you spend $100 and you walk out with one little bag of groceries. I mean, it just isn't the same. And so we all feel it as consumers, but it's a beautiful thing to be able to illustrate that and the impact it has over long periods of time.
Yeah, I love it. So now shifting gears to Steve's favorite conversation, and it's a term that he's coined, and I love it: continuous education. I want to talk about that, but I want to talk about it from a different angle a little bit here, Steve, because we're trying to talk about how the advisor can provide value to the client, to the prospect quickly. And you talked about using an educational approach before in terms of being more salesy, if you will. But here I want to talk about okay, so you're encouraging the advisor to engage in continuous education, be a part of the retirement analyzer community, be taking lots of lessons, showing up to your routine training, and just being active. But this can also be an approach that you take with your clients as well, right? The advisor can be continuously educating their client as well.
You have to. And we have this client portal now where the advisor can actually share the client's plan electronically. And the client has their own portal. They have their own portal. So they can sign in, they can look at whatever they want. We have this thing called a docu-tracker, which they can upload all their important financial documents, things like that. But yeah, I agree with you 100%. I think it's the responsibility of the advisor to stay educated. And you could actually set up a little structure for the clients to be educated also. You have all different types of clients, right? Some just want to make sure that you know what you're doing. That's all they want to hear about, pop the numbers in. Others want to participate. And then others are like engineers and they really want to participate. But we can handle all of them though. But I think it is a responsibility to try to teach clients how stuff works. So it's their plan, right? I mean, the more educated they are, to me, I enjoyed that when I was doing it. People that were educated and we could talk through things. But there's all different types out there. There are.
Yeah. Now, Brooke, on this topic of continuous education, I'm going to keep using it until it sticks.
Hold on, sir. I got to fix that. It's continuing educate.
Oh, I'm screwing it up.
It's continuous CE.
Yeah. Okay. I like it. All right. I'm feeling it. Okay. I'm feeling it. Great. All right. So, unfortunately, I can't edit what I said before, so we're just going to have you delete this correction. This is great. Okay. See, this lets we're real people here, folks, on the show. Brooke, so on this topic, and we are going to get that continuing education to stick. I love it. Brooke, what are the things that you've mentioned around this concept of continuing to train and up your skill? Is it's not just keystroke training, right? You talk a lot about concept training, and you've teed up a couple of really interesting concepts here that we've gone deep on, and I think they're fascinating. Why is concept education versus more tactical training so important for advisors who are looking to provide value to their clients?
As an advisor, I just don't think the days of transactional really work anymore. so much in the past, you roll in with a yellow pad and a little pamphlet from the company, and you're just jamming a product. And that's what the conversation was about. And I just don't think that really works anymore. There's too many tools. We're facing the online world where people can plunk anything in. They can find an online tool. They can get a retirement plan on their own. So you're battling that, and people are getting smarter, which is great. I mean, it's a great thing, but we have to do a better job as advisors, in my opinion. So being able to go in, show the plan, show the outcome, and the why. It all goes back to the why we're making these moves, why we're implementing these tax concepts. It just gives you a different talking point over the product. And I think, guys, users probably, I'm going to bank, would love to hear you both say continuing education 10 times.
I don't know if I can, you know what? I'm going to record myself and just loop it.
I know.
Well, listen, we're up on episode 1. We talked about we're going to need merch for the What If show. I think we're going to need some other merch that has, maybe on the front of the show, it'll say What If. And then on the back, it'll say continuing.
We have a better one. We have one where it says, we were talking about the monthly expense plan. We have one that says clump on your shirt with a line through it. And on the back, it says itemize. You can walk around with that.
I love it. Look, we're going to have a whole lot. It's a whole new revenue line for Thomas Gold. It's just going to be all the merch with all the stuff that comes out of this show. It's going to be fantastic. Perfect. It's awesome stuff.
Great.
Stickers for the office, the little placards, and your T-shirts and hats. It's going to be all good stuff.
Mike, let me just say one last thing though for what Brooke was saying though. I mean, it is really, really important what she's talking about. Okay. I want to say it one more time. The product, even though it's important, it's not important, right? Brooke's talking about solutions. You need products to actually put the solutions into play. Okay, guys, if you realize that, let's get them looking good so we can add the product. It's almost like you're creating a launching pad for product and strategy. But we have to alleviate the red line first. That's what we have to do. And once you get that down, I think 90% of the products look terrific. Once you get one, if you're looking on tab 6 and you have a terrible outcome, Brooke said it before, stop with the product. Okay. It's not going to help. You have to change the behavior. Once the behavior is changed, you got a launching pad for putting any strategy you want into play, and it should save. So
I love it. That is so true. Like, this is a behavior thing. It's kind of funny. I never thought about anybody. Nobody's ever put it that way, right? This is, obviously I always think about, finances like, hey, this is the fuel for living the life I want to live, right? Like, so make sure I have I'm safe. I got a nice home, and I have the ability to have transportation to go do things I can eat. All this, that money's a tool, right? But this process is all about behavior, right? What are you doing with the money? How are you allocating? How are you, spending it? And then, how are you investing it so that it, can live longer? That's really a great way of talking about it.
Let me say one thing, please, if I would. This is the funniest thing, I think, in our software, okay? What we do is we take all the income that's coming in, and we basically tax it. We analyze the tax, and we take contributions, and we take it out of that money. So we come up with a net monthly income that's after tax, and we compare that to the monthly expenses. And a lot of times it's positive. Okay, maybe it's $2,000 positive a month. You want to catch a client back on their heels? Ask them where the 2,000's going. And then all of a sudden it's complete silence, and the two clients start to fight with each other or whatever. No, I didn't spend it. You spent it here. But the point is, you're there, and you have an area that you need to talk about, and they know you mean business again. And that's what we do, though. If you're sitting and you calculate everything and you're showing a positive cash flow, all right, what are you doing with it?
Yeah.
$2,000 a month. What would you do with it? And see, that's the kind of thing you can do with RA. You're right in their business. All right. And you need to be there. So to help them out.
Well, and I think too, clients don't realize how much money they just blow. It might accumulate for a while, but then they buy the flat screen TV, grandchildren. That's often one line item with like the never ending zeros behind it. So just bringing that to their attention though is often just a good exercise in itself.
Yep.
I love it. That's fantastic. Grandchildren. Oh my God. God help me when that happens.
I know.
think it's going to be a big new line item we have to talk about, Brooke.
We'll put that in the monthly expense plan. Yes.
There you go. Great. All right. Well, now it is time for our fan favorite segment, Retirement BS with Brooke and Steve, where we tackle the retirement planning myths, misconceptions, and debates that come up in real advisor-client conversations. And today's topic, Brooke already kind of teed it up a tiny bit earlier on in this episode. It is, you should always maximize your 401k contribution. And so you already kind of hinted at that might not be true, Brooke. So I'll let you tee it off. Why is this potentially retirement BS?
Oh, I gave it away earlier, not even realizing. Again, though, often clients just dump money into their 401k without an employer match because it's what everybody else at work is doing. I guess I would challenge you to ask them, does that make the most sense? And then you can go into Retirement Analyzer, you can plug in, run two different scenarios and show them mathematically why maybe going with a max funded life insurance policy or a contribution into a Roth can do better for them in the long run.
And I'm going to simplify it a little bit though. So what you're doing is you're actually making a contribution to a 401k. You're getting a deduction, but a lot of people forget. They all want the deduction right away, right? But what do you have now? You have a responsibility to pay tax on that. Somebody's going to pay tax on the money. If it's not you, it's your beneficiaries. So the question is, what does it look like down the road, 20, 30 years? Do you know? I don't know. Okay, so that's the uncertainty. So you can either get a deduction now, it helps you, okay, but you have to pay tax later, or you don't get the deduction now, and you pop it into a Roth or a non-qualified account, and you won't have to pay taxes later a lot of the time. So what do you want to do? You're rolling the dice on taxation is what you're doing by contributing to the 401k. Might be good, but you got to, just about 2 or 3 years ago, we didn't know what was going to happen with the, this 2025 sunset, right? We didn't know what was going to happen with that. All right. So now we have a better idea that these taxes are going to stay around the way they are. I think, at least in my opinion, is a lot of times you should look at in this low tax environment what clients should do to get out of the 401k. So I think it is a myth. Not everybody should be maxing out their 401k because you're pushing that liability down the line, into the future, and there's uncertainty there.
Well, and double check too, because if a client's still working, some plans they can do in-service withdrawals, different things like that, where you can get the money out even while they're working. So ask those questions. The other thing, and I'll touch on it again, is just the employer match. If they're getting an employer match, hard to beat. Okay. But if they're not, run the numbers, look at alternatives.
I love it. I love it. So the BS verdict, maxing out your 401k is not always the right move. The right answer depends on your tax situation, your liquidity needs, your debt picture, and your long-term retirement vision.
That's what I was going to say. You stole every one of the words exactly like that. Well done. Well done.
All right. Now, and the real answer is the only way you're really going to know is to model it out with your client, right? So get into Retirement Analyzer, put all the options in there and do your what if scenario. That's how you'll know.
And you know what? I'll leave this too, though. Okay. If you have a problem with your 401k, you don't have to convert a lot. I mean, just trying to take money out of it now, at least slowly, you're getting something done. Right. And we can show that also. It kind of takes away from, the thing growing to something major like this time bomb that Ed Slott calls it. And then you have to worry about it down the road. So people are withdrawing it now in this favorable tax environment we're in. So
awesome stuff. Okay. So today we talked about showing value fast. We talked about tax planning without being a CPA. We talked about becoming an educator for your clients. And we talked about the 401k myth. What's the one thing you hope that advisors take away from this episode that, actually makes a big difference in their life?
Well, I would say it's really not that hard to get your flow, for lack of a better word, flow down. Going through a program like ours, you're going to protect yourself. You're going to show a client value. I think the most important thing is you're doing the things the same. Everybody has nuances in every plan that they have, but for the most part, we talked about the 3 tabs, 1, 2, and 3. They're the same. The data gathering is the same. Going to tab 7 is the same. And all you're trying to do is let a client know if they're going to be okay or not. So a program like ours gives you the track to run on. And again, you can scale it. There's a lot of companies that we deal with. Their whole company uses RA, 7 advisors or whatever it is, and they all use it. And that's how they built the company. So I would say, that's why it's such a good deal. I hope you take that away with you. We'll train you for it. We'll hold your hand. And then the sky's the limit for you.
Yeah, and I'm just going to echo that. The repeatable sales process lets you bring another advisor on and train them on your exact steps and make it duplicatable. And I think that makes it really easy if you're ever trying to sell your book of business or train somebody to take your place. It makes it a really easy transition.
Love it. Love it. That's a great way to close it out. So for those of you who are still with us, we want to make sure we hear from you. What was your big value moment that you've experienced in working with a client and using Retirement Analyzer, either as prospect or a client? Drop us a note, swing by thomasgold.com or retirementanalyzer.com, or leave a comment in the YouTubes if you are watching over there. Okay. Make sure you subscribe to the What If Show on your favorite podcast platform. We're on Apple Podcasts, Spotify, Amazon. As I mentioned, the YouTubes. We definitely want you here with us because we have a lot more awesomeness on the way. Brooke and Steve, this was a fantastic episode. Thank you so much. Great to see you.
Thanks.